Hello, everyone. So, welcome to video 5 in chapter 3. This video has kind of a high priority topic, and it has to do with automobile benefits. If I'm driving an automobile that I get from work for my personal reasons, personal usage, that confers a benefit. It confers a benefit because I'm using a vehicle that's not my own. So, we're going to discuss what makes an automobile and how are benefits calculated. So let's get to it. So the first thing we're going to do is we're going to define just kind of what an automobile is. The slides here are kind of restrained, so I'm going to go the text to elaborate. But just to start, when we discuss a motor vehicle, an automotive, we sort of mean any gas-powered or any self-propelled vehicle for driving on streets and highways. So we're talking about cars, vans, trucks, buses. So those are all motor vehicles. Passenger vehicles denote automobiles generally acquired after 1987. This is defined for CCA purposes. So a passenger vehicle is a vehicle designed to carry people, passengers. If it's a luxury vehicle, there's special CCA rules for a vehicle that's over $38,000 in 2025. This has been updated. It used to be, say, $30,000. It's been growing as prices of vehicles grow. So that's trying to say is um, any vehicle purchase above 38,000 is kind of considered to be luxury. And a vehicle that costs $25,000 will get you from point A to point B. To spend really too much more than that, you're driving for how nice the car is. It's not just about getting from one point to the other. But we're not going to talk too much about that. We will come back to passenger vehicles when we discuss CCA. Our focus here is automobiles. Any motor vehicle with a seating capacity of no more than 9 people, including the driver. So, motor vehicles is anything automotive that drives on the streets. Automobiles, for the purposes of the Tax Act, it holds 9 people or less. So, vans and trucks probably fall into automobile, but a city bus that can carry several dozens of people probably won't be. So we don't really get a benefit. A bus driver is not going to take a city bus on a personal work errand. He doesn't drive it home. He doesn't take it to the doctor's office. He won't drive his bus across the country for a family vacation. Or at least I would think that's a very rare occurrence. So automobile benefits is when a vehicle is available to us that we can use for personal reasons. If it holds less than 9 people, there are certain exceptions that apply, such as ambulances, fire trucks, police cars, specially marked emergency vehicles, again, probably aren't being used for personal reasons. So when I'm driving them around during the day, I think it's sort of expected that I'm driving them for work purposes. So we don't consider too much for automobile benefits for those specialty vehicles. To elaborate a bit more, going to this section, page 144 of the textbook. So, exceptions to the automobile is ambulances, fire trucks, police cars, motor vehicles used as buses or taxis. So, if a business is transporting individuals from one location to another, that's not an automobile for benefit purposes. Van, pickup trucks, or similar vehicles of seating capacity of no more than 3 people. So a construction site might have a truck for carrying materials and boards, and the truck might otherwise be considered an automobile, but if it can only hold 3 people, it's just the front cab. Its main purpose is that carrying capacity. So a van, pickup, or truck that has seating capacity of no more than 3 people. It can't really hold a large group. The same van and pickup trucks used more than 90% of the time for to transport goods, passengers, and equipment for business. So if we do have that van or pickup truck, as long as we make sure it is used almost entirely for business, then we're not going to worry about the one trip where someone takes it to go get lunch. It becomes immaterial at that point. And specifically for vans and pickup trucks, because of their ability for carrying materials and supplies. They serve a purpose outside of the transporting of passengers. However, if there's a van on site that sort of like like a van, a family van, or a minivan, that van is mostly about having seating capacity. It can hold up to 7 people. So that might be used to move crew from one place to another. So if the crew takes the van out to go for lunch, that might be considered a personal trip, and there might be a benefit conferred. Um, the words similar vehicle are not considered to include cars, but are considered to include SUVs and extended cab pickup. So they're trying to make a distinction between, a sedan, a four-door, or a two-seater, compared to other more um, functional utility-driven vehicles like vans, pickups, and perhaps SUVs. So going to the exercise related to this, just down here, here's a few examples. I'm going to try and go through it quickly because I do want to get to the discussion around benefits. A business offers a shuttle service to hotel guests to and from the airport. They purchase a shuttle bus that seats 9 people, including the driver. So it is an automobile, but the shuttle's used a minimum of 95% of the time. So since it's over that 95%, that 90% threshold, this is exempted from being considered an automobile, so we don't need to worry about benefit. A local restaurant expands its business to include delivery. It purchased 2 small cars to be used as delivery vehicles, each of which seats a maximum of 5 people. The vehicles are used 80% of the time for business. So that distinction for cars and their usage is reserved for like vans and pickup trucks. So the fact that these are 2 small cars, they're used 80% for business, they're still considered automobiles. So if those delivery drivers take those cars home and are able to have access to the cars, in the evening when to do personal trips, then that will confer a benefit. A local charity collects donations of food and clothing for local distribution and acquired 2 vans to pick up the donated items. The charity's tax exempt and does not carry on a business. The vans have a maximum seating capacity of 2 people. So even though the maximum seating capacity is below 3, they're not carrying on a business. So just to go through those first 3 items, our shuttle bus, 95% not an automobile. The delivery vehicles are automobiles because they're not specialty vehicles, so they're not excluded. The van might be exempt from automobiles but because it's a charity, they're not carrying on a business. So it doesn't get that exemption because there's no business function for their usage. A professional valuator purchases a Mercedes SUV for 125,000. It's used 75% to travel to and from clients in the course of business. That is still an automobile. Cars are only excluded when they're a taxi or specialty emergency vehicle, or if they're, say, a shuttle bus used for transporting passengers. This individual has the car in their name, but it's mostly for it's getting them from A to B, but for 125,000, it's definitely luxurious in its style. So there is an automobile benefit to it. Now we have a pickup truck that's going to have 2 situations. A construction company acquires an extended cab, heavy-duty pickup truck that can seat 5 people and transports heavy equipment and workers to numerous construction sites. Assume it's used 70% of the time or 95% of the time, the year it was purchased. Well, that percentage is critical. The percentage determines whether or not it's an automobile or not. We want to be over that 90% threshold. The seating capacity has more than 3 people, so it doesn't have the exemption based on seating. So we're going to rely on that usage number. So it's no when it's over 90%, yes when it's 70. And I have a short list of exclusions down here for your reference later. So I want to focus on what are the benefits. So motor vehicles, um, the benefit when motor vehicles are not automobiles. If they're not automobiles, then there we might still confer a benefit just based on number of kilometers driven. The CRA administratively accepts that fair market value would be equal to the reasonable allowance rates based on the number of personal kilometers. So if it's not an automobile, if I take it for a personal trip, it would be recognized that I'm receiving a benefit of 72 cents per kilometer, up to 5,000 kilometers and 66 cents after that. So they're saying, well, I'm not using, gas or my own wear and tear of my own vehicle. So that's the benefit I'm saving. So the CRA has picked a reasonable rate for it to be 72 cents. The other way, if I drive my personal car for work, so when I worked in accounting firms and I have to go to a client's site, I would drive there using my own vehicle. My work can reimburse me for that vehicle usage at these rates, and I would not have to include it in income. I've used my vehicle, I'm out that cost of 72 cents, and my work has simply reimbursed it back. So as long as those payment amounts are reasonable amongst these reasonable rates, then I don't need to include it in my income. And we will revisit that when we discuss allowances. But if I'm using a work vehicle, my benefit's 72 cents if it's not an automobile. So if it is an automobile, the employer can provide an automobile that's owned or leased, and the calculation modifies slightly for each method. It could be the employer pays an allowance to me. The employer pays allowance for employment-related use of employees' own automobile. So they say, hey, you're going to use your own automobile. What if we give you $1,500 a month and you just drive it around, and I will deduct from that $1,500 my actual cost for travel. So they give me the allowance, which gets added to my income, but then I get to deduct the direct travel expenses related to that business travel. So certain costs deductible by employee. So if that allowance of 1,500 is more than my costs, then I still have an income inclusion, that difference above it. So what constitutes personal travel? So personal use, the CRA does consider driving to work and back is a personal trip. Getting to work is an errand that an individual has to do on their own time. It's only once I'm at work is it employment use. So if I'm able to take a work vehicle home and back, I'm using it for personal use. Employment use, both trips, driving from home at start of the day directly to a client or a client of employer, um, or then to one's work location. So instead of driving to the office, then to the clients, I drive straight from my home. Well, that could be considered I'm now on company time because I need to drive from my office to the client to perform my job. So driving to work, personal. Driving to a client's business. Driving to and from one work's location and a client, customer, supplier of employer. There is this idea that so if I had a personal business, there's an office space. Maybe I work in construction. So there is an office space that I go to every day. But if my supplies or if I have a home office at home, as long as I can establish that I'm starting my work day at home or on my property, then that could be considered me being at work. And then that would convert those personal miles into employment use. So if I'm a contractor and all of the materials are in a barn on my property, I load up the materials and I go directly to, say, a client's location to start building them a deck or something. CRA considers one work location to be the place where employee regularly reports to work. CRA and courts require a logbook or equivalent be maintained. The reason for this is when I use a work vehicle, I'm conferring a benefit for personal kilometers. So I need to maintain a logbook that can prove how much of the kilometers are driven for work, how much of the kilometers are driven personally, because it's on those numbers that are going to greatly affect how much my benefit is going to be. Okay, income tax benefit provided in automobiles. Just worried about the time. Sorry. When I buy a car, I've paid for it. I give them $15,000 and now I have a vehicle. But that $15, that 15,000 doesn't allow me to drive the vehicle. That's what it cost to put the car in my driveway. Now that I have it available to me, to drive the car incurs gas, maintenance, insurance, perhaps some other related expenses. So the CRA considers this to be two separate charges. The standby charge, pretty much the purchase of the vehicle, is the cost to have it conveniently available to you, to have the car on standby. And then the cost to actually drive the vehicle is operating costs. So tax benefit is based on the fixed cost owning the vehicle. That is called a standby charge. The recurring or variable cost is considered the operating cost benefit. It is not based on the employer's actual cost. So if your work is paying those operating costs for you, they pay for the gas, they pay for the insurance. We don't care what they paid. We care that they paid. The operating cost benefit that you will report is a calculation. So we will use the calculation. We only care that your work paid because that says, hey, we have to calculate an operating cost. So the benefit that's being added to your income, for the most part or generally, won't equal the actual cost incurred to run the vehicle. Um, if we pay back amounts, so the employer's paying for the car, but we have to pay them back a certain amount of money, what we pay for the vehicle gets subtracted from our benefit. So we have a work car that's available to us. We have a standby charge. They're paying for the insurance and the gas and all that stuff. But maybe we have to pay them 500, $200 a month to pay for any incidentals. We'll calculate our benefit and we'll subtract that $200 a month that we paid because that's not a benefit to us. We paid for that amount. It's only what's above that value that's going to net into our income. So we will calculate these benefits, but we will subtract any amount that we paid. And then the sales tax component will be included in both benefits. So we will often include the GST in the purchase of the vehicle. Now, the operating cost uses specific rates, like per kilometer, but it is expected that those rates consider sales tax as part of the benefit. Okay, getting into standby. To make this calculation as simple as possible, your benefit to have the vehicle in your driveway is 2% of the cost of the vehicle per month. So if the vehicle was $10,000, 2% of that is $200. So $200 per month. For every month that vehicle is available to me, that is $200 I would not have had to spend to have a vehicle available to me. So we take the cost of the vehicle times 2% times the number of months it was available to us. So the cost does include sales tax. When we consider availability, we might not get number of months. They'll probably say number of days. It was available for 180 days. So we'll take those number of days and divide it by 30 to get an approximation of a number of months. And we'll round to the nearest whole number. We'll round, if we're exactly half, we'll round down, but above that, we will round up. But you round to the nearest whole number. So 180 days divided by 30 is 6. So if the car's been available for 180 days, we are considering us to have had 6 months. So 6 times 2% is 12%. So we will recognize 12% of the market cost of the vehicle, including sales tax. The employer leases the car. It's somewhat different because we have lease payments. They didn't spend $10,000 for the car. They spend $300 a month for the car. So the lease payments, we will have the benefit of 2/3 per month. So if it's $300 a month, we have to recognize $200 for every month that we have available to us. The lease payments will include GST, and the availability is the fraction where the numerator is the number of days the vehicle was available, and the denominator is the number of days in the year lease payments were made. So if it was available for 180 days and we've paid 6 months of lease payments, we can divvy that up. Since the lease payments often are monthly, we can usually get a pretty clear monthly per month rate. But sometimes lease payments might be per week or bi-weekly. So since they don't always have a set monthly payment, the wording here is just trying to get generally a monthly rate. So if I pay bi-weekly, each payment is worth, 14 days. So I need 2 payments to be a month. So the numerator is how many days it is available to us. How many days have I had lease payments for? So 6 months of lease payments will be or 6 months worth of lease payments will give us an availability factor of 6 months. If the employee had the use of the vehicle throughout the lease period, the value of the fraction is 1. So if I've had it for the whole time, the availability factor, if I've had it the whole time, then I've pretty much paying for a full year. Okay. I think I want to stop now because I want to give a full focus on doing the calculations. So I'm going to stop this video now. When we come back, we are going to jump right into actually calculating those benefits.